السلام عليكم ورحمة الله وبركاته. سبحانك لا علم لنا إلا ما علمتنا إنك أنت العليم الحكيم. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي ولا حول ولا قوة إلا بالله العلي العظيم. رب يسر ولا تؤسر أما بعد. Okay, for this chapter, which is the last chapter of our syllabus on consolidated statement of cash flows. So, an overview of what we're going to discuss in this chapter inside the Jane Lazar textbook is this mind map here. Okay, as you know, with regard to cash flow, in the previous semester, you have learned cash flows before. Okay, so cash flow statements for a group of companies is not much different from the cash flow for a single company. Okay, apart from others few differences, the method of preparation of cash flow is still the same as for a single company, which is we're going to find that there will be two methods for preparing of cash flows, which is direct method and indirect method. Okay, we will discuss this in this textbook. The textbook, at the end of the textbook, also discuss with regard to foreign exchange. Okay, we have discussed foreign exchange in our last topic, but we have not discussed on how to prepare for cash flows. For this semester, we do not cover this point, but it will be translated. If you have to translate a cash flow statement for a group of companies, you need to translate it at actual rate. Okay, at actual rate. So discussion on foreign exchange situation for cash flows is very short in this chapter in Jane Lazar. So what the text explain is that it's just that you need to translate using actual rate, but we're not going to cover that in our syllabus. So there are several things that which is quite different from the cash flow of a single company. If you prepare cash flow for the group of companies, normally these are the differences. Number one is with regard to dividend paid. Dividend paid, you have two types of dividend that you are going to receive and going to receive from the subsidiary. So the company, the group, or the holding company will receive dividend from subsidiary if it is subsidiary, or an associate if it has an associate company. So these are one of the key differences in group consolidated cash flows. Another one item is with regard to dividend received. Okay, dividend received. Normally, dividend received will be in the cash flow from investing activities, or cash flow from is included under cash flow from financing activities. Another difference is with regard to item which is acquisition of subsidiary during the year. Sometimes the holding company or the group acquire new subsidiary, so you have to determine what are the cash flow involved. Okay, and then sometimes you have the group which is disposing a subsidiary, so that means you have to find out what are the net cash outflow from these activities. And dividend again, you have dividend received from associate and also dividend received from subsidiary. And then dividend paid to NCI. Okay, dividend paid by the holding company to NCI, by the group to the NCI. So these are few differences in statement of cash flow for a group of companies. We're going to discuss this one by one. Okay, so anyway, our chapter on consolidated statement of cash flows. Before we move on, preparation of cash flows, just for review, a recap of what you learned so far in the previous semester, is that cash flow statements, there are two types or two method of preparation. which is direct method and indirect method. So the only difference between the direct method and the indirect method are the format for cash from operating activities, how you manage to get cash from operating activities. Okay, so for direct method, if you still remember, we start with cash receipt from customer, and then cash paid to supplier, and cash paid to employee and other cash payment, and then payment for tax. Then we get the cash flow from operating activities. Under the indirect method, however, we start the cash flows statement with profit before tax. Because this is indirect method, it means that we are calculating cash flow from operating activities indirectly from profit and loss. As you know, profit or loss is not cash. Therefore, we have to convert profit figure into cash by adjusting for non-cash item. So the non-cash item is depreciation. Example of non-cash item is less gain on disposal or at loss on revaluation. These are non-cash items. Some of the non-cash items. There are other non-cash items such as provision for doubtful debt and so on. So when we adjust this provision for non-cash item, then we can also, after that, we adjust for changes in working capital. Increase or decrease in inventory. Working capital means all the working capital which is asset, current asset minus current liability lah. Changes in working capital, which is mainly consists of inventory, receivable, prepayment, trade payables and accruals. This is working capital, current asset and current liability. So we're going to look at changes in this account. Okay, to find what is the changes, adjust for the changes, then tax paid. Okay, minus with tax paid, then we get cash flow from operating activities. So this figure here. Okay, so once we have calculate all this, then we get the net cash flow from operating activities. So between indirect method and direct method, the only difference is with regard to cash. How do we calculate cash flow from operating activities? The rest are the same. Cash flow from investing activities, cash flow from financing activities is the same. So this is what we're going to what we have done in the previous semester to calculate or to prepare for cash flow statements. So the cash flow statements is divided into three category, which is cash flow from operating, cash flows from investing, and cash flows from financing activities. So under group cash flow statements, there are, as I mentioned earlier, about 4 items which is available in the group cash flow statement, but not in the cash flow statement of the single company. The item are normally sale or disposal of subsidiary, and then dividend received from associate, and also acquisition of subsidiary during the year. Normally all these 3 items will be inside cash flow from investing activities. The other one is dividend paid to NCI. Dividend paid to NCIs will be under cash flow from financing activities. So we're going to discuss all these item which is particularly inside cash flow statement of the group one by one, because this is the only difference between cash flow statement for the group and cash flow statement for single activities. Okay, so as mentioned earlier, there are about 4 items. Okay, dividends paid by the subsidiary and associate, and you also need to have to calculate dividends paid to NCI, and then you have item acquisition of subsidiary and disposal of subsidiary. So let's take a look at the first item, which is dividends paid by the subsidiary and associate company. So what we need to find out in our preparation of cash flow statement is what are the cash flow involved in dividends paid by subsidiary and associate. Okay, so the cash flows between members of the group, namely the parent and the subsidiary, are not reported as cash as the cash is retained in the group, within the group. Okay, for example, if the subsidiary pays dividends, the parent to the parent, it does not entail an outflow of cash for the group. Okay, this is for subsidiary, which is pays dividend to the parent. So the dividend that the subsidiary pays to the parent is not a cash flow. Okay, the cash flow of the group is actually cash outflow or cash inflow from and outside the group. So if you have H and S here, if S pay dividend to H, this cash is already inside the group, so there is no cash flow for the group. The cash flow for the group represent the cash which is from the group to outside parties. Okay, cash from the group to outside parties. Dividends paid by the subsidiary to the non-controlling interest. This is the one that involving cash outflow, because NCI is the what we call the outsiders. Okay, NCI is the outsiders. So let's say that this is the NCI. Okay, normally because NCI is considered as outsiders, therefore any dividend that subsidiary paid, which is to the NCI, will be an outflow of cash. Therefore, the one that we want to find is the dividend paid to NCI, and it must be put under operating under the financial activities. Okay. Where associates in a group are accounted for using equity method, there will be changes in the carrying value of investment in associate during a reporting period. The cash flow implication is only the cash dividend received by the investor from the associate. Therefore, in the group statement of cash flows, the dividend received from associate will be shown as an inflow of cash from investing activities. So that would be cash inflows from investing activities. So that means we have cash inflows, which is dividend received from associate, and dividends paid to NCI will be cash outflows. Okay, which is under cash flow from financing activities. Dividend received from associate, cash inflows, will be under cash from financing activities. So now let's take a look at example number 1 to demonstrate the dividend received from associates and also dividends paid to NCI. Let's take a look at the example. Normally in a question or example, the question will give you consolidated statement of financial position for 2 years, current year and the previous year. So inside here you have all the assets and liabilities of the group. Remember, this is a consolidated balance sheet, which means the property, plant and equipment consists of H plus S, S1, S2, S3 if you have many subsidiaries. Okay, and also the same thing with regard to liabilities, H plus S1, S2 plus S3 and so on. Okay, and inside here there is a non-controlling interest. Okay, non-controlling interest. And then you will be asked to prepare the statement for consolidated cash flow statement. So this is the question also gives you consolidated profit and loss, consolidated profit and loss. So inside this consolidated profit and loss, there are items such as profit. Here it starts with profit before tax and share of profit from associates. You get profit before tax. And you have here tax, amount of tax, and then you get profit after tax. And then here will be the amount which is attributable to the holding company, and this is the NCI. So this is the NCI. So we need to find out how much is the NCIs that involve cash. Okay. Additional information. So inside this additional information, there is information with regard to tax charge for the year, and the dividends declared have all been paid, meaning that the tax amount here, profit before tax, and tax amount which is paid here, which is stated here, is also in the form of cash, because it mentioned that the tax charge and dividend declared all has been paid. So this is already in the form of cash. The dividend inside the the tax inside the profit and loss is also tax paid, because in the profit and loss normally it's not cash, it is based on accrual basis. So we do not know whether this is a cash or not. That's why we have to find out whether it is cash. It will be cash because if it is already paid. Okay, if it is already paid. So the first time we look at this amount, we do not know actually whether this is accrued cash paid plus accrual. Okay, normally this is on accrual basis, kan? The amount in the profit and loss will be normally based on accrual basis. So it could be cash plus accrued expenses or prepaid expenses. Therefore, we do not know. But looking at the additional information here, it mentioned that all has been paid. That means all of this is cash. Okay. So once you know that there is cash, you can directly put in your cash flow statement. Okay. For your cash flow statement, you will have put in your cash amount directly into this your cash flow statement. But before we start answering this type of question, we have to know how to prepare cash flows. Normally, there are two methods of cash flows, which is mentioned in should be mentioned by the question. If the question does not mention, then you have to find out which method, which information which is available in the question that allows you to prepare the cash flow statement. Sometimes, if you want to use direct method, the information given is not enough. Therefore, you have to prepare using indirect method. Normally, that is the case. Okay. So here, the method used is actually the indirect method. Okay. Here is indirect method because they start with cash flow from operating activity. Here they start with profit before tax. Okay, so that would be the indirect method that I have shown you here. Cash flow from operating activity start with profit before tax, which is indirect method. Okay, so in this question, okay, before we actually answer this type of question, we need to prepare the skeleton actually, the skeleton for statement of changes in equity. And also we need to first prepare movement, a schedule for movement in cash and cash equivalent. Normally the way that we answer a cash flow statement, normally we prepare the cash flow statement, the skeleton, meaning that the title, and then the subcategory, cash flow from operating, cash flow from investing, cash flow from financing. Then kita akan dapat net cash increase or decrease for the year, and cash equivalent at the beginning, plus cash and cash equivalent at the beginning, then you get cash and cash equivalent at the end. But the first schedule that you should make is actually movement of cash and cash equivalent, which is this schedule. This schedule will show the movement of cash for that for the company. So you start with you doing it with a 3 column like this: balance at beginning of cash and cash equivalent, balance at the end. So what is cash and cash equivalent here? Cash and cash equivalent is bank, cash in hand, bank, and also bank overdraft. Bank and also bank overdraft. Okay, so it could be bank or bank overdraft, and then cash in hand, and also short-term investment. Short-term investment are investment which is due within 1 year. Okay, investment that is due within, you are going to sell it and get return in 1 year. Okay, so that is cash and cash equivalent. So what we need to do is that we need to find out the changes or the movement at the beginning and at the end. Then we record the changes, whether it is positive or negative changes. So the total changes here will become the changes that going to be explained by the cash flow statement, our cash flow statement. So the amount that we have calculated in our schedule here should be the same as the amount of net increase or decrease for the year, for this period. Now going back to our question, for example here, we have bank balance, cash and cash equivalent. So what is cash and cash equivalent? Cash equivalent. So in cash and cash equivalent, what it means is that it means bank balance or bank overdraft, cash in hand, or short-term investment. So in this example here, in the profit in the balance sheet, there's only bank balance. There's no cash in hand, there is no bank overdraft, and also there is no short-term investment. So the bank balance here, we have to do a schedule. A schedule will look like this. Okay, so bank balance here, we started at the beginning, which is 15 here, last year, 15, and ending this year, ending is 30. That means from 15 it becomes 30. So during the year it increases by 15. So this is the changes that we want to explain in our cash flow statement. So the cash flow statement that we going to prepare must be, the answer is 15. Okay, must be 15, the same amount that we have cash calculated. This will represent the net increase in cash and cash equivalent, which is 15, that we have calculated in our changes in cash and cash equivalent here. Okay, so if you get different amount, and then that would mean you have done something wrong with your cash flow statement. So anyway, back to our example here. Our example here, the first additional information explain that the dividends declared and also the tax charge is already in the form of cash. So the dividends which is mentioned here in the profit and loss 25 here is already in the form of cash. This is the dividend paid by the holding company. So this represent dividends paid by the holding company. The cash here will be entered. You can directly enter the amount of tax and also dividend, because this is already in the form of cash, inside the cash flow. So in your cash flow statement, you will have all the title. The subtitle was for the category cash flow from finance operating activities, cash flow from investing activities, and cash flow from financing activities. Other item, you just leave it blank and then you fill in one by one. So the first amount that you can fill in is tax paid. Tax paid will be under cash flow from operating activities. Since we are using the indirect method, therefore the tax paid will be under here, tax paid, which is 40. Tax paid 40. Okay. And then dividend paid by the holding company would be financing activities. Dividend paid by the holding company would be financing activities 25. So the amount untuk tax already put in the cash flow, and also dividend paid by the holding company already in the cash flow. And part B, so this is done. Part B, the group depreciation is 30,000, and there was no disposal of non-current asset during the year. So this information is with regard to non-current asset, because non-current asset has depreciation. The question mentioned that the depreciation for the year is 30,000. Now, depreciation is also a non-cash item. Since we used indirect method, the non-cash item here will be affecting your cash flow at here. Non-cash item, depreciation. Since we start with profit before tax, profit before tax, we have to adjust for non-cash item. Number one is cash flow depreciation. So this one, depreciation is used in cash, non-cash item, and this information is also will be used in looking or finding out what are the cash involved in non-current asset, whether the non-current asset have changes. If the changes of non-current asset, we have to, if there is changes in non-current asset, we have to find out whether the changes have any cash implication. Where non-current asset, normally we have property, plant, equipment. For example, here the non-current asset at beginning is 300, at the end is 350. So if you want to find out the reason why this changes, because we want to find out whether there is any cash implication, cash outflow or cash inflow from these activities. We open up a property, plant and equipment. So if you open up a property, plant and equipment, property, plant and equipment here. So balance at beginning is 300,000. Balance at the end 350,000. And we know that the depreciation charge to P&L is 30,000. So 30,000 is charged to P&L. The one that we are practicing here is called a method of the method of finding cash here, the one that we are doing here is is called incomplete record method of finding amount for cash here. Okay, so for example here we know that this 30,000 depreciation is charged to P&L, meaning that debit P&L, credit property, plant and equipment. So, and then the question mentioned that there is no disposal of asset during the year. Normally kalau ada disposal will be on the side. Sorry. Okay. On the side, disposal. Okay, certain amount. But if there is no disposal mentioned here, so if you balance out this account, we will get 380 here. So it should be 380 here. So this is the balancing figure. The balancing figure is 80. So this 80 represent normally on the debit side. If it is 80 on the debit side, it could be one or two things. Number one is acquisition of property, plant and equipment, which is representing the cash that we buy, the cash amount that we use to buy the property, plant and equipment during the year, which is in this case, which is 80 lah. But it also can come from asset revaluation reserve, ARR. If you have revaluation and you have a surplus, then the surplus will be on this side, right? Also on the debit side. But in the question, if you take a look at the property, plant and equipment, if you have ARR, the balance sheet would have ARR here at the same time. Since there is no ARR here, that means there is no revaluation during the year. Okay, so the only reason why there is an increase of 80 here is because the company make an acquisition of new property, plant and equipment and paying for cash. So this is the amount that we are looking at, or we are looking for, to enter into the cash flow statement. Okay, into the cash flow statement. So our cash flow statement, you can directly enter this amount as acquisition of property, plant and equipment, or purchase of property, plant and equipment in category of investing activities. So you have here in your statement of cash flow, inside investing activities, purchase of property, plant and equipment, money going out. Okay, money going out, 80,000. Okay, next, so this is done. Next, we have the holding company's interest in the subsidiary and associate remain unchanged. That means there is no increase in the interest in the subsidiaries and associate company. With regard to changes in interest or increase in the percentage of acquisition and decrease in the percentage of acquisition, we do not cover that in this semester because due to time constraint or limit. Okay, so here, meaning that what it means here is that there is no increase of additional percentage of acquisition, okay, in subsidiary and also in associate. So once we have done the additional information, then we need to do what we need to do next in preparing cash flow statement is we need to look for item in the balance sheet. We need to find explanation with regard to why it is increased or decreased. So we have looked at into property, plant and equipment just now. We have settled this. We have found out that there is an acquisition of 80,000 during the year, which involve cash. The next item, we have to go through one by one the item in the balance sheet so that we do not miss anything. So the second amount, we look at investment in associate. So investment in associate, again, we need to find out dividend received from associate normally in terms of cash. So we need to find out, so investigate what happens here. Balance at beginning is 75, balance at the end is 80. So the changes is about 5, increase in 5. So we have to find out what is the reason. To find out this, the reasoning behind the increase, we have to do what the method that I mentioned earlier, which is incomplete record method, which is we open up the account first, investment in associate. Okay, they open the account first, investment in associate, put in all the figures, put in all the balance brought down 75, balance carried down 80. Okay, balance carried down 80, and then you have to find out in the profit and loss. If you take a look in the profit and loss, you will find out there is a share of profit from associate company. Okay, investment, increase in investment in associate, increase or decrease in investment in associate could be due to, number one is share of profit. Okay, so the share of profit here, credit P&L, debit investment in associate 15. It's 15 amount here. Okay, share of profit is 15, so 15 here. So the remaining balance here is 90. This should be 90. So the balancing figure would be dividend received. This is the amount of dividend in the form of cash received from associate. This will be entered into, this amount will be entered into the, this represent the cash involved, okay, in the investing activities. So it will be into the category of investing activities, dividend received from associate company, 10, working number 1. So we have to move on into another account here, inventory. The next account is inventory. So inventory here, there is a movement of 20. Okay, inventory, the movement increase and decrease in inventory, since we are using that indirect method, this will be recorded under the cash flow from operating activities. Okay, cash flow from operating activities here, we have increase or decrease in working capital, increase or decrease in working capital. So we have to find out what is the increase or decrease in inventory. Open up inventory account, or if you are already familiar with this, you just look at the difference here. Okay, so the difference here is balance beginning is 120, balance at the end is 40. So there is an increase. So an increase in inventory represent cash outflow or cash inflow. You have to ask yourself, what happens if there is an increase in inventory? Normally an increase in inventory is due to you purchase more inventory. Okay, purchase more inventory is as good as money going out. Okay, so that would be in the cash flow from operating activities. Money going out 20. Okay, next item, Bank balance, you do not have to do the bank balance because the bank balance is already inside cash, changes in cash and cash equivalent, where we have the bank balance here is here. This is the reason why we calculate the bank balance, because we want to explain the difference due to what. That's why we are preparing the cash flow statement on the first place. So the bank balance, we do not have to we already find out the bank balance, sorry. For the bank balance here, we have already prepared movement of cash and cash outflows, cash inflows, movement of cash and cash equivalent. Now, for ordinary shares, you have to find out if there is any changes. So there is no changes in regard to ordinary shares. That means there is no new issue, no bonus issue, and no so on. So there is no cash involved. Okay, with regard to ordinary shares. Retained profit, we're going to look at retained profit in more detail in our profit and loss statement, in our consolidated profit and loss. We're going to look the item in the consolidated profit and loss one by one after this. So we do not actually have to go through the retained profit. For non-controlling interest, so here the non-controlling interest, you have to open up the account for non-controlling interest to find out how much is the amount that is paid to the non-controlling interest, the dividend that is paid to the non-controlling interest. So the cash involved with regard to non-controlling interest will be in the form of cash paid to non-controlling interest, the dividend paid to the non-controlling interest. So you have to open up a non-controlling interest account, which is this account. Okay, open this account. So here we have put in the balance brought down, which is 90, balance carried down 97, and in the profit and loss, okay, you will find out that the non-controlling interest is 10. Okay, so this is amount which is transferred to the profit and loss, 10,000. Okay, so the double entry is actually debit non-controlling interest, credit consolidated profit and loss. Credit non-controlling interest 10, and debit the consolidated profit and loss. So the balancing figure here is 3. Okay, the balancing figure here is 3. This represents the dividends which is paid to the non-controlling interest. So this is the amount that we're going to put into the cash flow statement under finance activities. So in the financing activities, we will have dividends paid to non-controlling shareholders, 3, money going out. Okay, money going out. Next item in the consolidated balance sheet is trade payable. Okay, so trade payable is current liabilities, which is going to be entered into the category of, in the consolidated cash flow, it will be entered into changes in working capital. So the changes here is 10, 30, from 30 to 40, that means the changes is 10. The 10 amount will be entered in the changes in working capital. You have increase in trade payables. So you have to ask yourself, increase in trade payable represent cash outflow or cash inflows? You have to investigate. Increase in trade payable means that you are buying inventory from your supplier. Okay, from your supplier. So that means you are buying using credit, not cash, from your supplier. That means your supplier is giving you credit. You are receiving financing from your supplier. This one is as good as receiving money or cash. So the 10 here is money coming in. Money coming in. Okay, money coming in. Trade payables, increase in trade payable, money coming in. Okay, so we have finished looking in the item of consolidated balance sheet one by one. Next, we're going to look at the item in the profit and loss. So profit before tax, okay, the profit before tax here would be used in operating profit, okay, operating profit in the cash flow. Profit before tax. But here profit before tax dia ada dua, satu kat sini, satu kat sini. Jadi dia ambil kat sini. Dia ambil yang 148 ni. In this question, in this example, the answer is they took this amount, okay? Now, share of profit from associate company is it could be normally a non-cash item. This is normally a non-cash item. And then if you take this amount, then you have to deduct this amount. Okay? So 148, then you have to deduct 15 because this is a non-cash item. But if you take 133 in your answer, you don't have to deduct the 15, okay, because you already take the net. Okay, so you can take 148 or you can take 133, but if you take 148 you have to deduct 15. If you take 133 you do not have to deduct 15. So in this example they take 148, therefore 148 must be deducted with 15 share because it is a non-cash item. Okay, next we have dealt with share of profit from associate, profit before tax, and then we have tax. We have also dealt with just now. Tax paid, and then profit to the holding company, okay, and non-controlling interest. So non-controlling interest we have dealt with. The rest, okay, yang ni yang equity of yang equity holders, we do not have to find out how much cash involved here. Okay, so that's all. Okay, so everything is already entered in your cash flow statement here. So you can prepare your cash flow statement. So you have profit before tax minus depreciation, share of profit, you get 163, increase and decrease 20 and 10, you get 153, minus tax, you get 133, which is net cash from operating activities. Cash flow from investing activities, you have cash which is purchase of property, plant and equipment, money going out 80, dividend received from associate 10, so total negative 70. Cash flow from financing activities, you have dividends paid by holding company and dividends paid to the non-controlling interest, you get net outflow of 28. So inflow of 133 minus outflow 70 minus outflow 28, you get 15, which is the same amount, the amount that you have calculated in changes in cash and cash equivalent. Okay, the same amount. That means you have prepared it correctly. Okay, so you have correctly prepared your cash flow statements, and then plus balance at beginning, which is this amount, the amount which is also at beginning here, and this is the amount at the end. So this amount is already in cash and cash equivalent. So in your final exam, at least already put this one and this one here, because you already know that you get marks here. Okay. So the amount here must be balanced with the cash and cash equivalent you have calculated earlier. If it is not balanced, then that means there is something wrong with your cash flow statement. Okay. So this is a demonstration of example number 1, where we all have dividend received from associate and also dividend paid to NCI. So in this example, we have two dividends. One dividend received from associate, which is entered in the cash flow from investing activities. Okay, cash flow from investing activities. And dividend paid to non-controlling interest is inside cash flow from financing activities. That's how we find cash flow from dividend received from associate and also dividends paid to non-controlling shareholders. Okay, non-controlling interest. So that's all for today with regard to cash flow statement. We're going to continue with other item which is going to be discussed, which is not available in a single company, but only available in the group or consolidated cash flow. So we have discussed dividend from subsidiary and by associate company. Next, we're going to look at acquisition and disposal of subsidiary in our next session. Okay, so that's all for today for this session. Assalamualaikum warahmatullahi wabarakatuh.